Analysts keep using this one term and never explain what it actually means. Let's fix that today, because right now, with gold sitting at $4,680.60 an ounce and the Fed funds rate at 3.63%, this concept is doing more to drive gold prices than almost any other force in the market. The term is real yield, and if you have never fully understood what it means, you are not alone. Most financial media throws it around like everyone already knows, and almost nobody stops to explain the mechanics. So today we are going to fix that, step by step, using today's actual numbers to show you exactly why gold is at $4,680.60 and not $2,000, and not $800. Let's start with the basics. A nominal yield is just the stated interest rate on something like a US Treasury bond. If you buy a 10-year Treasury right now, the government promises to pay you a certain percentage per year. That sounds straightforward, but here is where most people stop thinking, and it costs them. That percentage is measured in dollars, and dollars lose value over time because of inflation. So the number printed on the bond is not actually what you earn in real purchasing power. What you earn in real terms is the nominal yield minus inflation. That remainder is the real yield. It sounds almost too simple, but the implications are enormous. Here is the analogy that makes this click. Imagine someone offers you a job paying $50 a day. Sounds fine, but then imagine that the price of everything you buy goes up by $55 a day while you are doing that job. You are technically earning money, but your real wage is negative. You are getting poorer even while you work. That is exactly what a negative real yield means for a bondholder. The government is technically paying you interest, but inflation is outpacing it, so your purchasing power shrinks anyway. And here is the fact that most people do not know: when real yields are negative or very low, gold historically goes up, because the reason most people hold bonds instead of gold is that bonds pay interest and gold does not. When that interest payment is wiped out by inflation, the entire argument for holding bonds over gold collapses. Now let's put real numbers on this using today's actual data. The federal funds rate is 3.63%. The US CPI index right now sits at 332.813. The year-over-year inflation rate implied by recent CPI readings has been running around 3.5% to 4%. So if you are earning 3.63% in nominal terms but inflation is eating 3.5% to 4% of your purchasing power, your real yield is somewhere between roughly negative 0.37% and barely positive, depending on exactly which inflation measure you use. That is almost nothing. In some real yield frameworks it is still negative. And gold is at $4,680.60. Coincidence? Not even close. Here is a historical fact that will make this crystal clear. Between 2020 and 2022, the Fed held nominal rates near zero while inflation surged to 9.1%. Real yields crashed to around negative 7%. In that same window, gold rose from roughly $1,500 an ounce to a then record above $2,000. Then in 2022, the Fed began the most aggressive rate hiking cycle in 40 years, pushing nominal rates above 5%. Real yields turned sharply positive, above 2% on 10-year treasuries in real terms. Gold pulled back and struggled to sustain gains for almost 2 years. That is not a theory. That is the mechanism working in real time, right in front of everyone, and yet almost nobody connected the dots publicly because the mainstream financial press never stopped to explain real yields simply. Now here is where it gets really interesting for where we are today. The Fed has been cutting rates. We are already down to 3.63% from a peak above 5.3%. Real GDP growth is only 1.5%, which means the economy is not strong enough to justify keeping rates high indefinitely. Meanwhile, inflation is sticky. The CPI at 332.813 is not trending decisively down. So the Fed is caught. Cut rates and real yields fall further, push real yields even lower, and gold has more room to run. Or hold rates and risk tipping a 1.5% GDP growth economy into a recession, which historically also drives gold higher as investors flee risk assets. There is a word for a situation like this where both roads lead to the same destination. That word is a structural bull market. Warren Buffett recently issued what many analysts are calling his most explicit warning yet about overvalued US equities. And here is the expert-level connection most commentators missed. Buffett's warning is actually a real yield story. When he says stocks are expensive, what he means in quantitative terms is that the earnings yield on stocks, that is, corporate earnings divided by the stock price, is not high enough to compensate for the risk you are taking versus what you could get from bonds. But if bond real yields are also near zero or negative, then neither stocks nor bonds are offering genuine real returns. Both asset classes are simultaneously unattractive in real purchasing power terms. That leaves gold, not as a trade, not as a speculation, but as the only major asset class where you are not actively losing ground to inflation or overvaluation. Several of you have asked in the comments where gold goes from $4,680.60 by end of 2026, and I want to answer that in real yield terms, not as a price prediction, but as a framework you can now use yourself. If the Fed continues cutting and real yields drift further toward zero or below, history shows gold has repriced sharply higher in every comparable cycle. If inflation stays sticky around 3.5% to 4% while the Fed cuts toward 3% or below, real yields go negative again in a meaningful way, and you are looking at a gold market with serious structural tailwinds. The viewers asking whether $5,000 is realistic should be watching the real yield on 10-year TIPS, Treasury inflation-protected securities, as their indicator, not just the gold price itself. When TIPS real yields approach zero, gold has historically outperformed nearly every other asset. Here is one more fact that should genuinely surprise you. Central banks around the world, particularly in China, India, Poland, and Turkey, bought over 1,000 tons of gold for the third consecutive year in 2023. That is the longest sustained central bank buying streak in recorded modern history. These institutions have entire floors of economists calculating real yields in real time. They are not buying gold as a gut feeling. They are buying it because their own models show that real yields in US dollars are insufficient to justify holding dollar reserves over physical gold. They are making the real yield trade at a sovereign level. Retail investors are, in many cases, still catching up. So here is where you are now. You can explain real yields. Nominal rate minus inflation equals real yield. When real yields are low or negative, holding cash or bonds quietly destroys purchasing power, and gold, which holds purchasing power over centuries, becomes the rational alternative. The Fed is at 3.63%, inflation is sticky, GDP is soft at 1.5%, and gold is at $4,680.60 for a reason. Not hype, not fear, not speculation. The mechanism is visible if you know what to look for, and now you do. If this kind of deep dive explanation is what you want more of, subscribe to this channel because every week we take exactly this approach, one concept, explained from the ground up, anchored to real current data, so you walk away actually understanding the market, not just hearing about it. Hit the notification bell so you never miss a new video the day it drops. And before you go, one thing I want to be straight with you about. I am not a financial advisor, I am someone genuinely obsessed with understanding how this works. Everything here is my own research and thinking, so treat it as one well-researched perspective and always do your own digging before any decision. That transparency is something I will never compromise on, because the moment this channel stops being honest with you, it stops being worth your time. Thank you for watching, and I will see you in the next one.